Hello, good evening. Thank you to all of you who've joined us this evening. This is our fifth webinar of the year, again, one a month. We're doing our best to ensure that our audience stays informed on all things regarding the dental M&A landscape. It's an ever-changing landscape, and sometimes we want to kind of take a break from current events and share with you our experience and share with you how we have seen great companies achieve higher than expected returns on the sale of their business, how they really maximize the business when they sell. In effect, how do they exit at the top, right? So that's really what we're going to be focusing on tonight. And we're going to do this through looking at 5 considerations to ensure that you exit at the top when you are ready to sell your life's work and sell your business. Thanks to you all for joining this evening and making time in your busy schedules and making this investment inside of your practice and inside of the value of the practice for all your stakeholders. My name is Kevin Cumbus. I'm the president, founder of TUSK Partners. TUSK is a sell-side M&A advisor focused exclusively on the dental economy. We work across every state, every specialty, and have the great pleasure of helping our clients create multi-generational wealth events for their families and their estates. We've got a great team here at our office of 9 who are fully committed to the process and the project, who frankly just love the work. You know, what I love about TUSK is that it's really the perfect marriage of our collective operating histories. When you look at the businesses that our team has worked at over the life of their careers in finance, investment banking, and private equity, and mergers and acquisitions, it's not just dental. This is not something that just came out of the ground yesterday. Seasoned professionals that have a long history at some of the biggest and best firms in our great economy on the finance side. And then when you marry that with the great businesses that we've all been lucky enough to work with for in the dental and healthcare side, that's really where TUSK lives. It's the marriage between those two segments. So passionate around value creation, really want everyone to know your practice is worth much more than you think it is. And man, we love taking deals to market and helping our clients maximize that value. Okay, moving on. All right, so tonight we're going to cover really 5 considerations for helping you exit at the top. One is around which EBITDA. Which EBITDA are we focused on? Who's calculating the EBITDA? We talk so much about it, we defined it, but we're going to kind of do we've done the 101 class on this. We're going to get to the 200 and 300 level classes to make you more of an expert on EBITDA and how every buyer is likely going to have a different view of a target's EBITDA and why. So that's going to be a really interesting conversation. Item 2 is that the highest valuations are set by the market. It was a big deal that traded recently. Dental Care Alliance was owned by Harvest Partners. Harvest engaged an investment bank to take them to market, ran a marketed process, and ultimately found the right buyer for them. I was on the phone with leadership from American Dental Partners recently. They engaged an investment banking group to take them to market and ultimately found the right buyer for them. These large groups always run marketed processes because they know that drives up value. So we'll kind of pull apart some of the deals we've worked on and help you see how that value manifests itself over time in going through a process. All right, number 3, structure of your deal will drive total transaction value. All too often, we hear, I got 12x on my EBITDA. Okay, 2 questions. One, which EBITDA? And 12x, like how much, like what's the structure look like? How much that was cash? How much was equity? What class of equity? Was there an earnout? Was there a holdback? And what are you getting paid post-sale as a clinician inside of your business? There's so much to unpack here. We're going to go and teach some examples for some real live deals, looking at 6 offers where The quantitative and qualitative aspects of each offer vary greatly, right? And we received 6 LOIs. It's like 2 or 3 pieces of paper, a couple numbers scribbled on there. Don't tell you a whole heck of a lot. But when you lay out the expected cash flows associated with the structure of each deal, you can really start to see where the value lives. So I wanted to give you a peek behind the curtain on how we do that, so you can see the impact of having multiple bidders at the table. Number 4, a letter of intent really does matter. We're going to define what a letter of intent is and what it is not, and help you understand the way we think about letters of intent. It is a legal document. It is not an obligation to sell, but there are some things you're signing up for that we want to make sure you understand. I think the execution of a letter of intent is sometimes done too cavalierly, but it is something you need to take very, very seriously and consider what your options are and what your options are not after you execute it. So I think that there's a lot of education that we need to keep doing on the letter of intent process. And then finally, we're going to talk about legal advice. You can't close your deal. I don't recommend closing a deal without an excellent attorney. I've always tried to connect myself and my business to the best CPAs and accountants and attorneys that I can. They can save you money. They can create opportunities for you. They can create flexibility for you. So I want to spend some time on that. Okay, that's it. Pretty good agenda for tonight. And thank you again for joining. So without further ado, we'll go ahead and get started. All right, EBITDA. I saw a funny little, I guess it was a tweet the other day by Austin Reef. It said, if your CEO doesn't know what EBITDA means, I would start looking for a new job. I feel like if you've been on our webinars over the last couple of years and you still don't know what EBITDA is, just pick up the phone and give us a call, right? This is the metric on which you are measured. And it seems to be the buzzword of our industry these days with good reason. But when it comes down to your EBITDA, when you're working with buyers in an unsolicited world, they are typically the ones who are calculating it. If your accountant is calculating it, that's okay. But what changes are they making to your net income to get there? We see every accountant under the sun's EBITDA calculations, and most of them are inaccurate by our standards. Some of them are inaccurate to the tune of 20 or 30%. The calculation isn't terribly complicated, but how you get there does take some precision of a surgeon. We want to make sure that that we're working with our clients to define exactly what that EBITDA is on a trailing 12-month basis, that we take control for how someone's going to be handling things such as Omicron, which still lives inside of TTM financials, trailing 12-month financials, and help the buyers understand where the business is going from a run rate perspective. Omicron was December, January. We have some buyers arguing that there was pent-up demand in February and March, and we can't give you full credit for those months. And we really want to look to April and May, maybe as the months on which we can build a run rate EBITDA, but there's seasonality in your business. Look, again, I'm not saying that buyers are doing things maliciously, but we all know that they're capitalists and want to buy low and sell high. So you want an advocate who can position your business with the highest possible EBITDA on which buyers will place a bid. Most times, everyone is focused on the trailing 12-month EBITDA. But what this excludes, or might include just partially, are growth opportunities or strategic initiatives inside of your business or an acquisition pipeline. So I'll give you a couple examples. We had a client that was overpaying for too many software services such as patient reviews, practice management software, patient reminders of appointments. And they found one piece of software that aggregated all of that and saved them about $150,000 per year, every year. They were about 2 months into that migration. So the impact of that had only shown up in their trailing 12-month EBITDA for a 2-month time period. And we were able to get them full credit for that adjustment looking back the entire 12-month period, because we knew it was going to manifest in the months to come. So that was a strategic initiative that we got added. Other growth opportunities might be an orthodontic group that has recently hired an oral surgeon. They're sending out millions of dollars of third molar extraction so they can, make sure that they get their cases just well. But rather than send that out, we've seen orthodontists say, well, we're going to hire an oral surgery to come into our practice, pay them somewhere between 40 to 50% of collections, and we're going to keep some or most of that money inside of our entity. Oh, by the way, most of that's going to fall to the bottom and create EBITDA. If you've only been doing that for a short number of months, or if you've recently just hired the oral surgeon to do it, we want to make sure that you get credit for that. Finally, acquisition pipelines. If you are growing rapidly and you have an actionable pipeline with deals that are under letter of intent or in various phases of development through your BD team, we believe you should get paid for that. Now, all of this has to be done in a marketed way because not all buyers are going to give you credit for it. So, we want to kind of build up the TTM EBITDA, some adjustments, some strategic initiatives, growth opportunities, pipeline, on and on and on, to show the value to multiple buyers. And from there, they will have a view on what they think is rational and reasonable for them to bid on. When you think about EBITDA, the next thing I normally think about is the comparable. What's the multiple? And these are helpful, but they don't always tell the whole story. When someone tells you they got a 12x, you don't know on what. You don't know how many locations. You don't know if they were shrinking, if they were growing, what their profit margins were, what their providers were, what their payer mix was. And I want to kind of show you what that looks like here. All right, so here's an example of all that we just learned in action. A buyer comes to a target, says, let me see your financials. I'm very interested in you. I've loved your business from afar. We've met your leadership at the Dykema event. We feel like there's a great fit here culturally. You're in the geography we want to be in. When we look at you, we see us. It feels great. Perfect. You send them your financials, and they come back and go, oh my God, congratulations, I'm building a remarkable business. We have you at $3 million of EBITDA. And because you are who you are and you have built what you have built, we're going to really stretch on this deal. And we're actually going to pay you 12 times that $3 million of EBITDA for a $36 million transaction value. I mean, man, that must feel incredible. Well, is there money being left on the table? I mean, $36 million is a ton of money, and a 12x deal is something you could certainly be proud of and tell folks, at the cocktail party at this year's Dykema event out in Denver. But when we looked at it, we might have said, well, there certainly is $3 million of EBITDA, but there's some add backs that we were not given credit for. Maybe these were capital expenses that were run through the income statement that should have been depreciated on the balance sheet. Potentially, these are family members that work inside of the business, quote with air quotes, work inside of the business. And that's a great tax shelter and a great way to get money out of your practice and to your loved ones, but they're not providing any real services. Potentially, there were some one-time expenses related to COVID or Omicron. Potentially, there were some gasoline expenses, some costs that you went to Costco and you bought a bunch of dental supplies, or you bought the stuff for the kitchen, and 2 or 3 flat screen TVs might have fallen into the cart as well by accident. we'd look at that and add all that back because those are non-essential, non-recurring, non-operating expenses. So we go, all right, so we add 600 to the 3 million, and then we get to $3.6 million of net EBITDA. Well, that 12x deal quickly becomes a 10x deal when I divide 36 million by $3.6 million. I'm going to be kind of like Ron Popeil here, but wait, there's more, right? But wait, there's more. This company also has some pretty strong strategic initiatives in place. They've got cost-saving initiatives. They've recently gone back. They noticed that their supply bills were really, really high. They thought they were running at 4 to 5%. Turns out they're running at 11%. They sent their entire, all their invoices over the last 12 months to 4 supply companies, and they all came back with a pro forma of what the future costs would be. And I mean, they could save them $300,000 out of the gate, no problem. They haven't yet kicked this off, but they know it's there. We know it's real. And this has not been identified by the buyer. We go, okay, well, that's another 300 grand. When we add 300 grand to 3.6 million, it gets up to 3.9 million. And when I divide the 3.9 to 36 million, that 10x multiple becomes a 9.2x multiple. So we were starting to see some real deterioration here on the multiple. They also have a really robust pipeline. They've got 4 deals under letter of intent near closing worth $1 million of EBITDA. They probably have some other deals as well that just aren't quite under letter of intent yet. Pretty certain we can get them credit here for the $1 million they have under pipeline and bring that net EBITDA from 3.9 up to 4.9. And again, dividing the 4.9 to 36 million shows you results in a 7.3 times multiple. All of a sudden, that 12x deal is not feeling as good. Finally, there's the pro forma of where the business is going. You know, you may have some de novos. You may have some businesses that are EBITDA neutral or a drag on EBITDA that are showing great patient growth. A new doctor has been added, a new specialty has been added, a new specialist has been added. And there's another $500,000 of additional benefit there where, you know, we're going to be increasing this again up to another 500,000 up to 5.4 million. So net, I mean, what you could be looking at is a adjusted net EBITDA on a pro forma basis of north of 5 million that results in about a 6.7x deal. So it's likely that 4.5 million would trade at or above 10 times for 54 million. And this seller could have left up to $18 million on the table. Again, I wanted to show this to y'all to see, so you can see the way buyers are thinking about your EBITDA and frankly, the way we see your EBITDA and how we want to position it in the market. This is really what, so EBITDA matters. Yes, we understand what the definition is, but how do you get to the EBITDA that gives you a defendable position and it gives you an EBITDA that many buyers would be interested in bidding off of? Okay, highest valuation results from a market and sales process. This should not be a surprise to anybody. You know, we just are pretty fresh off the Kentucky Derby, one of the most fascinating horse races, exciting horse races I've seen in a long time. That horse race was not a one-horse race. We had a long shot come from way far behind and win that race. But when you're working with one buyer, one potential suitor who comes to you and says, hey, I'd like to buy your practice, send me your financials and tell me what you want for it. You are operating in a one-horse race. There's one bidder, there's one interest party, there's one suitor. They are in control. There's no competition. They're going to control the pace the whole time. They're only going to pay what they have to. And you as the target have no leverage. I mean, your best alternative to a negotiated deal is not do the deal. So you can't really play these bidders against one another. And a lot of times we'll hear from folks who have done unsolicited offer deals and they'll say, you know, I just didn't want to be the bad guy. I wanted to start the partnership on good terms. So I probably didn't push as hard as I could because I wanted to be a good partner there. I will tell you, we are not afraid to be the bad guy. We are not afraid to serve that role because you get one chance to sell your business. So let us serve that role for you. Don't use this as a chance to don't allow yourself to default to this I'm just going to be good, I'm just going to be nice position, because again they want you to be a part of the deal and they want you to be a good partner all day long, but they don't want to pay a penny more than they have to. So a competitive race is a very different race. In a competitive race, we have multiple bidders, multiple interested parties, and they know that they're in a competitive process. And they know someone's going to win the deal, and they are certain someone's working around the clock. And what I love most about these deals is we set the pace of the deal. Anytime we take a deal to market, in our confidential information memorandum, in the SIM that we send out detailing the highlights of the practice, we tell all bidders, here's the schedule of events. You receive the confidential information memorandum on this date. We expect you to submit indications of interest by this date. You will have management meetings between these two dates. We need final LOIs by that date. Really what we're doing there is we're forcing this to become a priority for them. We want all their attention on your deal. I don't want them scattered thinking about the other deals that they could be working on all those unsolicited deals that they're not working on or kind of half-assing. I want them 100% focused on your deal and know that we are racing to a finish line. Other great things about this is you get to sit in front of all the buyers, and all of a sudden, they're all selling you. You get to learn about them. You get to think about not just price and structure, but culture and fit and future. And is there an opportunity for you to level up inside of the organization? Are you content being just a provider on a go-forward basis? But ultimately, it's the gift of choice. And choice is an important piece of this dynamic because it really, you want to make sure that who you're working with is going to take care of you, your stakeholders, your team, and your patients. Not all DSOs are created equal. If you've only seen one DSO, you've only seen one DSO. You've heard us say that many, many times, but a competitive race gives you access to the market. And you're making a well-informed decision when you've been through a competitive process. I want to show you a case study of a deal that we did recently that really articulates the value of a marketed process. So client came to us with an offer in hand for $15 million. And they said, look, we really like this offer. We think it's a good company. I think we could be comfortable with them. Could you help us out though? The words they used were, we just don't know what we don't know. I said, yeah, absolutely. Happy to do it. We ran the numbers. We ran the process. Actually took the deal out to 44 groups. 12 of those groups submitted indications of interest, and 6 of them submitted letters of intent. Ultimately, we had one bidder. The graph I'm about to show you shows the increase in total enterprise value over time as we marched through each phase of this process. Let's bring this up. Okay, down the left-hand side here, you see total enterprise value, 15 million, 20 million, 25 million. The day they came to us, they had one unsolicited offer for 15 million bucks. We did the analytics, we pulled together the marketing materials, we took it out to 44 buyers. So 44 buyers represents this tall light green graph here. We went from 44 buyers down to 12 indications of interest. 12 folks said, look, I'm interested. I've looked at the data room. I understand the opportunity. I'm in. And we had an offer at $19,250,000. So we're already over $4 million over where they started. And we're just at the indication of interest level. Next, we invited 8 of the 12 to management meetings. Our clients performed beautifully. We really prepped them and helped them help them through some FAQs, like questions that we know buyers are going to be asking, and made sure that they were prepared to answer those questions in ways that were, one, absolutely truthful, but two, left the buyer saying, these guys get it. They understand what we're after. They understand what we're looking for. They are exactly the type of doctor we want to work with. And we're going to sharpen our pencils after management meetings and raise our bids. And they did just that. So we went from 19 and a quarter up to 20 and a quarter $1 million over the course of the management meetings. We then had letters of intent due a couple short weeks later. Everyone raised their bids again. From the management meetings, we had 8 of those. 6 actually ended up submitting letters of intent. A little of that was due to the guidance that we gave the buyers about where this deal needed to trade based on what we were seeing from the market. So now we're close to 23 million. We begin to negotiate these offers against one another. Our clients are taking calls and having conversations with the leaders, leaning into certain deals at some points and leaning away from other deals at other points. Ultimately, the partner that they chose had a total enterprise value of $26 million. That is a transformational change from 15 million. So the winning bid was 26 million, 66% over the initial offer. It was a home run. It was a grand slam for our clients. And this is the type of stuff we love to do. We love to work with groups that have an unsolicited offer in hand, feel pretty good about it, because we know we can add value to their process. That is not an isolated incident. We've done it across all specialties. We've done it across single locations, multiple locations. It's really something we take a lot of great pride in, increasing that offer and making sure that our clients don't leave any pennies on the table. All right, let's shift gears to deal structure. So deal structure I define as like there's enterprise value, right? Let's say it's $1 million. From there, the buyers are going to want you to allocate that $1 million into a couple of different buckets or tranches. One tranche is going to be cash. One tranche could be equity of some type, be it joint venture equity, holdco equity, DSO equity, sub DSO equity. The list goes on and on and on. And then maybe there's another slug for earnouts as well. And there's all sorts of derivations in between. But the structure is, how are you receiving the dollars over time? How many years separate you from the total transaction value of the deal? And is there interest attached to the dollars that you're not receiving on day one? Is there upside attached to it? Are there dividends attached to it? Lots and lots and lots of questions to ask. So I am certain, that structure drives long-term value. And if we see 3 bids from 3 DSOs, all at 20 million, the expected 10-year cash flows from those 3 deals are vastly different. So let's start by saying no 2 deals or no 2 DSOs are the same. They're just not. If you look at a DSO that's private equity backed, you need to know, 1, who backs them, who's their sponsor. 2, when did that private equity group make an investment? And 3, when are they likely going to get out? Because that'll drive the return, because everyone's offering a different equity package. And that's just on the whole equity. Some groups are offering something called JV equity or joint venture equity. You need to think about this type of equity really is more of a dividend stock than a growth stock, because the joint venture equity is equity that lives at the practice level that you're selling. And you should expect dividends from this equity tranche, most of the times quarterly, but sometimes it's subjected to a management fee, meaning I'll pay you quarterly after I pay myself the management fee, and sometimes it's not. And many times you don't know how much control you have over the expense side of the income statement. How many expenses can they jam into your income statement to decrease that dividend to you and your family? We know all those answers that can help you with all that. The second tranche is holdco or DSO equity. I think of this slug of equity as a growth stock, high growth stock. Think tech stock, right? Tech stocks don't pay dividends. You buy a tech stock for the appreciation of that stock price over time. We've all seen the statistics. If you'd have bought Amazon 10 years ago, hell, if you bought it right before the day before the pandemic, you'd be a wealthy person. Okay, the last 12 months notwithstanding, I know the market's kind of bouncing around 52-week lows, but you get my point, right? The holdco or the DSO equity is an investment that you make that has very little liquidity and the possibility of a lot of upside, but you have no control as to when you actually get your money back, because you only get your money back when that private equity group sells. The other thing you don't know is how much equity can you sell when that private equity group sells? Is it all of it? Is it 50% of it? Is it 80% of it? Short answer is a lot of the times it's to be determined. And when that private equity group sells, you have the privilege, the opportunity to sell, but not the obligation to sell. So there's a lot to unpack, even just on the equity side of the equation. But the LOI should lay out all of these components for you, so you with an advisor can kind of piece through this and understand where value lives in this deal and how the cash flows are received. So when we look at deals like this, we like to really try to take what is, apples, bananas, and pineapples and get to an apples to apples comparison. A letter of intent is like a 2 or 3, sometimes 7-page document with a ton of words on it, and then a couple of numbers. And very rarely do we see cash flows attached to it. So what we do is we take all these offers and start to lay them out digitally in Excel to try to get to an apples to apples comparison. And we look at various pieces of the trade, such as the allocation of the enterprise value. Cash, holdco equity, location units, sub-DSO equity, JV equity, retained ownership, newco, earnout, on and on and on. Then there's the escrow. How much of your money, let's think back to that $1 million deal, how much of that $1 million is going into an escrow, which is an account that will be maintained by the law firm and released once some things are satisfied? How much is going to be in escrow? Is it 10% of the total transaction value? Is it 10% of the cash? Is it 5%? Is it 15%? What's driving it? Every group is different. How long will the escrow be? 6 months, 12 months, 18 months, 2 years? What drives the term? Is there a holdback on this deal? Meaning some capital is going to be held back until there's a triggering event. Is it a triggering event? Is that triggering event exclusively time? Or is it the retention of an employee? Or is it the associates all staying? Like what are we really talking about here? These are dollars at risk. So we want for our clients to get the most money as soon as possible with the highest return and the least amount of risk. I think that's what everybody wants, right? That's the way I think about my investing. So all of this is connected to that. Distributions from equity. Do I get distributions on a quarterly basis? Yes or no? Is there a management fee? Yes or no? Do I get paid my distributions before or after the management fee? When are they going to recap? What is the expected return on investment with respect to that recap? What's their infrastructure look like? What am I going to be paid post-sale? Hey, is there going to be an earnout if I overperform? Am I getting a salary in addition to the commission for clinical work? Are you going to pay me for the AR? Some do, some don't. How are we going to allocate the price of the deal? Meaning, for tax purposes, what's going to be the allocation between fixed assets and goodwill, which drive the blended tax rate? Because I got to pay Uncle Sam in the bank, right? So the less I have to pay Uncle Sam, the more net benefit I have. If you're a C Corp in particular, this is a big deal. So if you're a C Corp, call us. We've got some advice for you all. Do they take into consideration the asset conditions? What's the non-compete going to be like? What about a non-solicit? When are they going to close? How long do they want exclusivity? Will they grant my associates equity? I mean, it's a ton of stuff. So when we work with groups, and I'll just kind of give you a preview here, we lay these out and score them good, better, best, and help our clients make an informed decision about what they want to do. That's one piece of it, right? Qualitative, quantitative, employment terms, but this is really interesting to me. On all those deals, enterprise value is interesting, but the forced allocations actually drive cash flows. So when we look at these cash flows over time, excluding the commissions from clinical care, you can see the big winner here is DSO number 2. But our clients did not choose to go with DSO number 2 because most of their return came in at an expected recap. And the recap that the leadership team of the DSO were giving us, we did not believe were actually attainable. And they went with a group with the leaders that they were closer to and more aligned with, that did not depend so much on the recap to get them to a reasonable rate of return. You have to run the cash flows to see the true value. Just look at the rolling totals, right? The prices were all relatively in the same range. Well, we got rolling totals here, one of 46 million and one of 22 million. And if you got an unsolicited offer from DSO number 3, you might feel really good about the LOI and the enterprise value and the multiple that they provided you based on EBITDA that they calculated. But if you had this offer too, you'd quickly know that maybe that probably isn't the deal that you want to take. Okay. Final thing on deal structure, there is too much focus on price and multiple. This is really just the tip of the iceberg. Where everyone really should be continue to focus, not be most focused on, but continue to focus on. Just don't go, all right, it's a 10X deal. I feel great. Let's sign it. It's below the waterline is where deals go south. The clawbacks, class of equity, earnouts, termination rights, non-compete, equity dilution, the buyer's illiquidity, the quality of the buyer's equity and reputation risk. We take this all into consideration, and you should take all this into consideration when you're thinking about doing a deal. All right, moving on. Letter of intent. Okay, so let's start by defining it. A letter of intent is a non-binding legal document that provides an overview of some of the deal terms and grants the buyer an exclusive right to perform diligence on your business to consider moving forward with the transaction. What I didn't say is these cement the terms and then nothing will change and that all points are covered. The other thing I didn't say is you have to do a deal with them. Buyers love to tell targets, hey, just sign the letter of intent. Let us do some further analysis, and then we'll come back to you with the offer. This is dangerous territory. The minute you've signed a letter of intent, legally all you've done is say, I'm not going to market my practice to anybody else, and should someone else express interest, I can't respond, or I've got to let the person that I signed the LOI with, I've got to make them aware that I've been contacted, but I certainly can't entertain any additional offers. There's always a time period there, a year, 6 months, 90 days, 60 days, 30 days, but there's some period of time at which you are locked out from having any future conversations with any other buyers. Additionally, they're going to be doing diligence on you, and you should be doing diligence on them. And you can't do any diligence on the other buyers. And they could get to the end of the diligence and say, hey, look, I know we agreed to a $10 million purchase price, and because we assumed the EBITDA was X, but the quality of earnings firm that we hired, that we directed, has come back, and the EBITDA is not what we thought it was. And we still love you and still want to do a deal with you. But unfortunately, we can't do $10 million. But what we can do is 8 million. And we can put a $2 million earn out there to get you to 10, so long as the business doubles. I think that should get us there, don't you? So the terms can change, and not all deal terms are laid out in this letter of intent. So when we see LOIs, and we see loads of them, we run them through a 39-point checklist to make sure that all the points that we want are in there. Rarely are half of the points addressed. Rarely. If you've got an LOI on your desk right now, you take a look at it. Some of them are really skimpy, and some of them are, frankly, like they're really nice. They're 6 pages, 7 pages, lots of graphs, lots of tables, crystal clear. Those are the ones we like, but even they have points of negotiation that they are silent on. We like to go ahead and get all that negotiation to the best of our ability done, so there are no surprises walking towards closing. After you sign the letter of intent, the next step they're going to do is go through a quality of earnings, and that's verification of your revenues and your EBITDA. And that's when things can really begin to shape, shift, and change. Now, I get it. There's a reason for all this. They need a period of exclusive diligence to do their work and to verify their numbers and get to an EBITDA that their lender can underwrite to. This is the way the whole world works in M&A. So I get it. Just be prepared for another conversation / negotiation around your numbers. You're not done negotiating yet. Far from it. I mean, really, a lot can change from indication of interest or letter of intent to closing. That's why you have to have a good attorney. When we're onboarding new clients, they may have a friend work with them early on to be on calls who's an attorney. Hey, this is my attorney. He's on all my calls with me. I want him to join and talk with you guys at TUSK. Great, happy to do it. Come to find out it's his brother-in-law who went to law school, but actually is in commercial real estate. That's fine. A great advisor. Happy to have him on the call. But as we sign them up as a client, we're quick to let them know we're going to have to connect you to a dental deal attorney because these transactions are different. When I say a dental deal attorney, what I don't mean is the local regional attorney that does dentist to dentist transactions, where a dentist is selling 100% of her practice to another dentist and walking away. Those are really clean. They are really simple. Deals with DSOs are complicated, and the legal work that comes along with it is vast. If you were to print the documents from any of the deals we have done, my guess is after printing all the legal documents, you'd probably be looking at, I don't know, 3 or 4 inches of paper. And if you have more partners, more ownership stakes, it goes up in inches. The paperwork is voluminous. So you want to make sure you hire an attorney who is very, very familiar with DSO transactions and in some cases familiar with the buyer. There are some DSOs out there that at the back of their LOI, they have suggested attorneys. They recommend that you call. All right, so just hit pause for a minute here. So you've entrusted this group to value your business based off of your numbers. You've given them the ability to calculate your EBITDA, and then they're going to provide an attorney to you to close the deal. That's just not altruistic. And there are great attorneys on the list, but just maybe get someone who the buyer is not recommending. That's all I'm saying. Okay. We've talked about your LOI. It's done. High-level business terms are in there. There's 100 more things to negotiate once the LOI is executed, including but not limited to escrows, indemnities, reps of warranties, covenants, non-competes, employment agreements, and termination rights. You got a lot more coming, is what I'm saying. And you want to try to get this deal closed quickly. So you want to work with an attorney that can help you understand what's negotiable, what's not negotiable, what's a business point, what's a legal point, and where you need to focus your energy. Yeah, you will need to print everything. Yep, you will need to read everything, but a great attorney can point you to the most pertinent and negotiable items. There are certain things that are way off market that attorneys who don't do these deals all the time will try to negotiate, end up wasting a lot of time, but maybe more importantly, your money. So we strongly encourage you to reach out to the groups that are good at this, that do a lot of this work, know the buyers and know their documents. Thank you for joining me tonight for these 5 topics. It's always a pleasure to spend time with you. If you've got questions about ways to maximize your business and exit at the top, please reach out to us here at TUSK. Thank you for your time.